Yeah, one of my favorite metrics every month, the NFIB, like Small Business Owners Survey, which we watch for the general sentiment of smaller businesses. But they have a question, and this goes back like 35 years. Do you expect is credit easier or harder to get right now than it was before, right? So it kind of goes like this in the curve, but it's literally never been positive. Right? Literally never in the history of the survey did small businesses say, it's easier today than it was and I expect it to get better. So that just shows you, these are very small businesses, I should emphasize, like 80% are under 20 employees. But nonetheless, it goes to your point. I guess the obvious analogy here is, private credit is to publicly traded or bank credit as private equity is to public equity, just in the sense of, in the public markets, there's a sense of diversification. It's a little bit more of a generic exposure to the asset class. But you also have within private equity, that ongoing residual criticism of either you're just kind of benefiting from not having to mark stuff in real time, or it's a leverage effect, or the past returns were when this was a small industry and now the forward-going returns when there's so much capital in it might not be as good. How would you respond to that, Mike?
There's a couple things to unpack in there. I think your primary analogy is a good jumping off point, and we just said it, that good companies are staying private longer, and you can see that just in things like the time to IPO. You can begin to see it in the number of publicly traded companies, which is half of what it was a couple of decades ago. You can see it in the concentration of market cap in the public companies that was just talked about on the prior panel. You can see it in the concentration of market cap in the traded debt markets. So there is this huge secular trend to growth in private markets that can't be ignored. And so whether you're talking about private credit filling that gap or private equity filling that gap, that is real. The other thing in terms of this not valuing, again, I think that's a little bit of a false narrative. Institutional and retail investors want to be in the private market for that smoothing effect, right? I think there's a misconception that because of the technical factors in the public equity market, which are driven by retail investment, high velocity of capital, algorithmic trading, et cetera, that that's the right justifier of the value or the intrinsic value of a company. Whereas in the private market, if you have a company that's performing on plan and growing its cash flow, that stability is reflected in lower volatility in the marks. And that's actually of a great benefit to the investor. So that to me is not a huge disconnect. That just speaks to the structural differences in the public market versus the private market. But that is one of the reasons why people want to stay private longer. They don't want to have to deal with the implications of that, the amplification of the volatility.